And welcome back to the MedTech Wealth Advisor Show. I'm your host, Matt Nelson, and today we have an exciting episode tailored for you, our MedTech professional audience. I know how complex financial planning can be, especially when you've got a lot of stock compensation to manage. And you're trying to navigate this tax strategies. We're coming into a tax filing deadline. So today I've got a real treat for you. Joining us today is Conner Kelderman, CPA. He's the founder of Track, which is a tax advisory firm, tax services firm. They do consulting and tax prep, the whole gamut. Conner has over 12 years of diverse tax experience with individuals and businesses. He's got a track record with firms like KPMG, Global Tax Network. He's a licensed CPA in Minnesota, member of AICPA, MNCPA, and he's just passionate about helping professionals like you just make confident decisions. Outside of taxes, Conner is a dedicated family man. He's an avid cyclist. I'm sure we could talk about that a bit offline, Conner.
Yeah.
And I understand a bit of a coffee connoisseur. So today he's going to help us understand the ins and outs of tax filing, stock-based compensation, a little bit on estate planning issues. But welcome to the show, Conner.
Yeah, thanks a lot for having me.
Anything I missed in that intro I should have brought up?
I do say I'm not a coffee snob. I just like my coffee. So I like it done well, and I like it. We actually combine the two, cycling and coffee, on a weekly coffee run cycling ride in Minneapolis here.
Perfect. Classic. You got to have your coffee. I love those the waffles you can get at the houses with that too. Stuff them in the back. Yep. Very good. I almost said snob, but I figured, I'll let you go there with that.
Yeah. Thanks.
Well, excellent. Let's just jump right in. So like I mentioned, top of the show, tax filing deadlines coming up. I'm sure you and your firm are just, super busy getting ready for that. One of the things, with clients that we have that are getting ready with all the paperwork, if whether they have a bunch of RSUs or some stock options, maybe just participated in the ESPP plan, there's still a lot of misunderstanding around how to handle the taxes with it. As simple as it should seem, it's not. The paperwork to gather and so forth. So I thought let's just start there. What do you have? What comes to mind for you around documents, deadlines, helping you do your job better?
Yeah. We are kicking off the filing season now. So this is, typically the time of year that your W-2 is going to be coming in the next week or so. 1099s are coming in February and so on. And so we got to know what we are expecting to receive, right? Where we're going to receive that information. And if there's any additional information we need to find based on equity compensation that might not be on a 1099. Certain brokerages have some supplemental information, some of them call it, where a portion of your equity compensation might already be reported in your W-2, your compensation statement you get from your employer. So we need to make sure that if you're already taxed on your equity compensation in your W-2, that might need to make an adjustment on your capital gain or loss calculation when you get that 1099. So we're helping clients make sure that, we don't just blindly say, thanks for the W-2 and thanks for the 1099, let's get it reported. Because one of the most common mistakes we see is the basis adjustments getting missed as far as equity compensation reporting on a tax return. So we're going to make sure we get all that information.
For those that aren't familiar with it, maybe just give us an example, kind of almost a case study of it, because I've been doing this for a while, but even me, I look at it, I'm like, why don't the tax forms just have everything you need in a simple readout?
Yeah, it goes back to the back end of how employers and brokerages are required to share information and report information to the IRS or on a 1099. And a simple example is somebody, is receiving RSUs, restricted stock units. So maybe they're on a quarterly vesting schedule, and each quarter they get a little bit more, deposited into their account. That's compensation to an employee, meaning that's taxable income. And so say they get, 10 shares of their company stock, and maybe they sell it right away once they receive it. So it's kind of an in and an out as far as holding the stock for an hour and then selling it, and now they have the cash. That transaction is going to be reported in their W-2. So on the back end with the employer, they know they gave you these 10 shares, that maybe that's worth $5,000. $5,000 is going to be put on a pay slip the next pay period, and $5,000 of compensation will be reported there. Then come tax return time, you're going to get your 1099, and we're going to see a transaction for selling $5,000 worth of RSUs, right? And sometimes there, depending on how it was reported, there may be the basis, which basis is essentially what you're not going to pay tax on, because that's like your cost basis or your income inclusion, whatever it is. That basis may not be there, or it may be only part of what your full basis is. And so we're going to first look at what's reported on the 1099. Say, is there an adjustment needed?
Mm-hmm.
If there is, we're going to make sure that what you already paid tax on, the $5,000 included in your W-2, you see your annual earning number, it's already included in that number. We don't want to pay tax on it again when we report the capital gain transaction. So we make sure 5,000 of basis shows up on the schedule in the tax return, so that we match the W-2 and the 1099.
Okay. Yeah. I mean, when you go through it sounds like a lot. It's probably not that complicated in the back end, as long as you have the right forms.
Right. Yeah. But it can be really easy to miss because, I have clients that get 1099s that'll have, $25,000 worth of stock transactions and zero as cost basis.
Sure.
And that's just because the brokerage firm doesn't know what your cost basis is. So you need to actively make that adjustment on your tax return. And simply, you don't want to be paying tax on $25,000 twice. And it's a very easy mistake to make.
Yeah, exactly. And now you were kind of given the example of RSUs. My understanding is ESPP reporting can almost be a little more complicated. Do you have examples to share of something like that?
Yeah, so it's known as a qualifying period of an ESPP. If there's different timing, right, where there's a grant or a start of an offering period where you can start to buy shares, as your company will, sometimes take whatever 10% of your paycheck and put it towards the company stock. You get a discount on that stock, right? So you don't pay the full value. You might pay 85 or 90% of the stock price for it. But the qualifying period, we have to hold the shares to get the best tax treatment we can get 2 years after the grant date, the qualifying period. And then 1 year after purchase is when you actually, take hold of those shares.
Mm-hmm.
And sometimes people miss that because they think, in my brokerage account, it says I'm on to long-term capital gains because I've held this stock for 1 year. But if the offering period was only 6 months, we might have still 6 more months to wait. So it's just something to watch for, working with an advisor like you to make sure they know when those are. So a simple example is if somebody, after 1 year maybe didn't meet this full qualifying period that they need to be aware of, but they did get to long-term capital gains, the discount they received, so call it, let's say 15% that they received, where they only had to pay 85% for a stock, is going to be included in their W-2 as income. So they're going to pay normal income tax rates on that. But then any gain or loss from the date of purchase, when the offering period closed, and then when they ultimately sold the share, is going to be a capital gain or loss transaction. So we have two different things we have to worry about because it's included in your W-2 from the discount portion in that example, but you still may have a gain or loss reported on your tax return.
For as simple of a plan as it should be and most common, it's the one that most people can participate in. It does get a little more complex in the reporting than you'd think. What our experience is that more and more of the big players, like let's say Fidelity, they are trying to help this by essentially blocking people from selling their shares until they've met certain dates, which helps. But we still have certainly, I'm sure you've got plenty of stories where that maybe wasn't the case, or maybe someone actually was able to transfer their shares away to another brokerage firm before these periods were met. And then the whole thing, it's a crapshoot basically of if it's going to get reported right or not.
Yeah.
Okay. Well, that's very good to know. So a number of documents to gather. So like in your process with your clients, do you have a good checklist for people to know what documents, if they have all the various types of equity comp, that they should be looking for, the supplemental forms and all of that?
We do, yeah, because the easy ones we usually know about is a W-2 and a 1099, right? We know we're going to get W-2 from my employer and 1099 from a Fidelity type of brokerage. But then depending on the type of compensation, ESPPs, there may be a 3922 form that's just going to report some of this information I need to do that exact example of reporting to get what's there. There's a 3921 if there's incentive stock options, which are very nuanced, but a different type of equity compensation. And then ultimately from the brokerage, we know on our end that it depends on the brokerage where it might be, where E-Trade now, Morgan Stanley generally will submit or have a second kind of tax document in a way. So I'm an employee at a company that has equity compensation. It's traded through Morgan Stanley E-Trade. I go into my Morgan Stanley account and I download my 1099. That might not be everything I need. There might be a second PDF document to download there that says like supplemental information. And that's going to be very, very important to get this right with these basis adjustments. Whereas like Fidelity, for instance, in your example, Fidelity does a good job putting that actually in the 1099 document. So it might be there. And then there's other brokerages that this might be all up to you. You might not have any sort of separate documentation. So just working with your tax provider, CPA, EA, whoever that is, and making sure that you're comfortable that you have the right basis reported and the right information to get to that adjustment that might be needed.
This is a perfect example of why it's important. If you have stock compensation, even just a little bit, doesn't even have to be a major portion of your comp, but that you're working with a professional like you and your firm, or our firm, someone who knows about these nuances, because you just mentioned 3 different major brokerage firms that all handle a lot of stock compensation, and they all do it a little differently. And so if you're not familiar with that or know that something seems off, it can easily get lost. So
absolutely can.
Very good tips. If you, if you have a checklist, we could include it in the show notes, and that'll be helpful for the listeners. Okay. So kind of covered a bit of documents. Are there any special key deadlines we have to worry about that are different?
So I think a deadline to first be knowing about is that there's 2 that I think I briefly mentioned it, where January 31, we need to receive our W-2s from our employers, or from payroll, salary, all that stuff on a W-2. A brokerage account has until February 15 to get you that information. So make sure you're waiting until at least February 15 to get the initial 1099. Be aware that sometimes there's adjustments on corrected 1099s, and be on the lookout for emails or whatever from your specific brokerage firm that may have a corrected 1099. And then ultimately, we're working towards the April 15 filing deadline. And depending on when you have the information, if you need more time, extensions are not, uncommon for people with equity compensation to gather this information. And you can extend your tax return until October 15 to file. So we push that, everybody knows April 15 is tax day. We push that up to October, give you a little bit more time to gather information, but we still need to be paying tax by April 15. So we're working with clients in that situation to say, okay, yep, let's get the information we can right now, to do the best calculation we can to see where we're at, if we expect to owe some additional tax, or if we're in a refund position. If we owe some additional tax, let's make an estimate towards that so we can avoid some interest and penalty after April 15.
Yeah, that's a great tip. With basically, if you have equity compensation or you're a business owner, it's fine to do tax, extensions. Maybe it's even better because you've got
sometimes
the time to to think about it. It gives you a firm like you plenty of time to get other deadlines out of the way, and then you can work with them. So yeah, extensions are not a problem, but you mentioned that key there, and we've had an experience with that in the past, or I've seen it in the past where, I filed an extension. I've got a whole extra however amount of time to pay this tax. Meanwhile, they leave the money, let's say, invested in their stock comp. Maybe they don't sell their RSUs. They're thinking they're going to sell that to pay the tax. They comes October 15th and stock has gone down. Plus they should have paid it back in April. So you've got to be working with someone who knows what they're talking about. Yeah. Excellent. Okay. So those are some good tips there. We talked a little bit about common mistakes and missteps, but I mean, any other ones that come to mind, just that maybe you've seen in your firm where we could help people avoid?
Yeah, I think even down to when equity compensation gets granted to you, don't make the common mistake of just saying, great, I have equity. Really try to understand what you have. Work with somebody like you, Matt, to understand, okay, I'm participating in the employee stock purchase plan, ESPP. What does that mean for me? I'm buying my company stock at a discount. Okay, great. I have RSUs granted to me. This means I have now essentially a bonus plan. If it's a year-long vest, 4-year vest sometimes, that I'm going to be receiving future compensation, but I need to meet a vesting period, generally based on just being at the company, still employed at vest dates, in order to receive this future compensation. Or you have non-qualified stock options, and now I have a difference between I'm going to meet a vesting a period where now, okay, I can actually do something with these shares, but there's a difference between an RSU and a non-qualified option where now I have to actually exercise the right to own these shares. And that may or may not make sense in situations. And I just see it all the time where typically people just say, I think I have RSUs, or I think, I'm in the ESPP, and they're not fully understanding what their compensation structure is. And that's really, really important to just set yourself up well, not only from a tax perspective, but just even in a future income perspective of how much exposure do you have with the company's results and things, and the company stock price in your overall compensation plan. When will those events take place, and so on. So just understanding what you have is a big thing that I see generally people kind of lose sight of and just say, great, it's more compensation.
Sure. Yeah, that makes total sense. Yeah, just kind of anecdotally, some of the clients you have, how heavy does their compensation get from a stock compensation? Have you seen people in the 50+% of their comp?
Yeah, especially as you get up the ranks and more executive levels, definitely becomes even a majority of compensation is in the form of equity compensation, and it's something where that can really depend on the the maturity of the company. Where if you're out in a startup type environment, they might have not have a lot of value right now, but it could be in 2, 3, 4, 5 years. This sways, and because of stock appreciation and the company doing well, it can all of a sudden be a heavy majority of your overall compensation. And so there's different factors that make that different for each client, but certainly, I mean, people kind of start with RSUs, and then generally non-qualified options we see as a kind of second level of participants in equity plans versus a startup type of a company. Heavy compensation to start up to really incentivize the early employees to really grow that company and have some sort of liquidation event in the future.
Yeah, no, that's good. And part of the reason I brought that up is I think by the time you get to the ranks where 50% or more of your comp is coming from stock comp, you probably understand it a little bit more. It doesn't mean you understand everything. You still need to work with probably an expert. But sometimes I find that, people who have much less, maybe it's in the only 5, 10, 15% of their comp, it's new to them.
Mm-hmm.
It seems like a small deal because in their mind, it's not as much of their compensation, but frankly, that's where a lot of the mistakes are getting made because it's just early on. So, just, you don't have to have a lot to really be paying attention to what we're talking about here. So.
Yeah, and quickly, one other tax mistake I think that comes to mind is when the percentage of overall compensation starts to be more and more in equity, we have to deal with the supplemental tax withholding rates in payroll,
Sure.
right? And so supplemental tax rates just mean what you filled out with the payroll group on your W-4. That's the form they're going to say, hey, Matt, please fill this out so we know how much to withhold from each of your paychecks. That is irrelevant from a one-off like equity compensation perspective. You're going to have 22% for federal taxes. Us based in Minnesota is 6.25%. Other states have their own supplemental rates. Both of those in Minnesota for a fairly highly compensated individual is actually going to be too little taxes withheld from these equity compensation as they vest. So an RSU as an example. They'll think, great, they took 22% for federal and 6.25 for Minnesota tax here in Minnesota. But in reality, they may owe 25 or 30% at the federal level, and for sure in Minnesota, we're more like 8% for a pretty highly compensated individual, sometimes 9 or 10. And so that those two rates, even though they feel like the tax was handled, is actually not enough, and that can be a surprise tax bill when you get to your return.
Yeah, and my understanding is the tax penalties have gotten to be actually something to pay attention to, where a few years ago they weren't as much.
Yeah, that tracks the interest rate because really during the year, it's called an underpayment penalty, but really it is essentially like you have a loan for a tax you should have paid during the year that you didn't pay. So they charge you underpayment interest. And that's right now, well, it was at 8%. I don't know if we're back down to 7% after the recent interest rate changes, but that's obviously not a small number to be paying interest on. Yeah.
Yeah, absolutely. That's super helpful. Well, good. That was some, very good information on kind of the equity comp side. Just, prepping for taxes, what to pay attention to. There was just a couple quick things to sort of wrap up. Last year, I know that you sent out some information, in kind of an informational email about the IRS RMD relief. They released a notice about that. And familiar with it a little bit, but maybe you could just run through why that's important. And this would be for, essentially if you're retired at this point, you have an IRA, but go through what the importance of this change was.
Yeah, so it was related to inheriting an IRA. Generally, that was kind of the main thing. There's some confusion around in the market right now, where there was an initial law called the Secure Act. And then we passed, or no, the Congress passed a Secure 2.0 Act, so a second change. And in that, there was some confusion of they changed the rules from you used to receive an inherited IRA, so an individual retirement account from someone that passed, and that you were the beneficiary of that account. So you receive that money. That's a taxable or qualified account. So as you take money out of the account, you pay taxes on it then. And so it used to be that you would have a similar RMD schedule. An RMD is a required minimum distribution. So each year, even though you have this account, the IRS says you can't just hold this forever. You have to take a little bit out each time. And it's calculated based on age and your life expectancy, essentially. And so it used to be you could spread this out over a long period of time and take it just a little bit year over year, or take it sooner and pay some tax on it. The Secure 2.0 Act said, nope, you have 10 years to use this money. And there's some confusion around, well, if I have 10 years to use this money, do I still need to take money out each year like I would have if this person passed in 2018? Or now that they passed in 2021, do I just have 10 years from 2021 to drain the account, but don't need to take any money out at any specific schedule? And the market was essentially like, we're not positive. We need IRS guidance on this. And so there was a couple notices from the IRS the last couple of years, essentially saying, give us more time to tell you what we need to do here. And so for the last few years, there's been essentially forgiveness of any RMD requirement to say, whether you took it or not, we're not going to charge any penalties or require that required minimum distribution was taken. But in 2024, the notice you're referencing, they said by 2025, we're going to have this answer. So we're holding on to that, and hopefully they will have an answer here soon for us. We don't have the answer yet, but that would tell us whether the minimum amount that has to come out of the account during a 10-year period is required, or if we truly do have 10 years from the date of death, that could be all in 1 year. It could be 1/10 over 10 years, or whatever the schedule you want.
Yeah, we gotta have an answer on this, definitively, and it's super important. I think tying back to our kind of client we're talking about that would have stock compensation, because let's say you get a large, you're coming into, well, let me back up. This would be a classic case we would see someone in their, let's say, early 50s. They have moved up in the ranks. Significant portion of their compensation is coming from stock comp. They know that's going to happen the next 5-10 years. And right about that time, at that age, unfortunately, parents are probably starting to pass away. Maybe their parents were 75 or so, 75, 80. So now they have an inherited IRA issue to deal with. So it is super important to know, can we wait the full 10 years until they're about to retire and and then we can deal with the stock compensation the first few years and then wait on the IRA withdrawal or not. So really important for our clients to understand this.
Absolutely.
This has been super helpful. I think we'll leave it there so people's heads don't spin on this. But I really appreciate you coming on the show and sharing some of your knowledge. As people can see, Conner's very knowledgeable, and he's got a whole team behind him that he's building with Track. And so if you need some advice or want a second opinion even, feel free to reach out to him. Conner, where would they easily find you? And do you have social handles, all of that?
Yeah. They can find us at trackcpa.com, Track the CPA, most of the social channels. Or feel free to reach out to me. Conner@trackcpa.com is my email address. And yeah, exactly that. I mean, we are taking new clients. We're building out the team so that we can help people through this, getting a 2024 tax return prepared, and then setting a good step forward to, okay, what does 2025 look like? Let's start planning on then right after we get the 2024 return completed.
Sure. Okay. Yeah. And just as an FYI, since we're moving into, end of January, and probably by the time people hear this will be, mid-February, is there a bit of a deadline for you to take on new clients for the 2024 year?
Yeah, it's a bit tongue in cheek, right? You're not going to have the same experience if you call me on, March 15 and want to get on the list to file it within a month. That's going to be a tough ask for us, right? Just given we all have essentially 2 months from we're getting 1099s, like I mentioned, on February 15. 2 months later, we got to file, and so. The sooner the better. Absolutely. We sent all of our returning and new clients their initial correspondence and kind of action items this week. And so getting on our list is good. We generally say once we're into March, we have to be at least potentially exploring an extension, right? Just because from our vantage point, whether or not we can get it done, we want to make sure we get it done and are very thorough and don't rush through things. So there's no reason to rush it. If we know we've done a quick calculation, we feel good about where we're at, let's take time to be sure you're a new client. Let's go through everything with a fine tooth comb to make sure we have it all pulled together and then file, May 1st or whenever that is.
Yeah. All right. Again, and there you have it. We're going to wrap there. Thanks for spending the time with us today. Remember, until next time, financial freedom takes more than money. So find your purpose and live your life well. If you need any guidance, we're here to help. Take care of each other out there.